In today's April mortgage interest rate update, we have a whole bunch of things to unpack. First and foremost is the coming interest rate hikes. Second is everything that happened in the bond market in the last month, and it was a doozy. And last is the unintended consequences of the finance department and OSFI's decision around the stress test and why that is making variables even more attractive from a qualifying perspective as well as from an interest rate perspective. And that's everything we're going to talk about in today's interest rate update, including at the end, we're going to talk about what all the interest rates are, and I'll give you a hint. They've gone up across the board, and we're going to talk about strategy going forward with respect to those interest rates. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers. We are 1,500 subscribers away, so we are going to give away $5,000 very soon to one lucky subscriber, but you need to be subscribed to win. And I recommend you turn on the notifications bell because that's how you're going to learn how to go about entering in the final draw for that $5,000. So let's get into it. Let's discuss everything with respect to interest rates right now. Let's start first and foremost with the headlines here. This is a big one. Big six banks unanimously predict that there will be a 0.5% interest rate hike next week. This is no secret right now. It is quite obvious that we are probably going to get a mega increase in April of about 0.5%. And the reason why is multifold. One is inflation. Two is the added growth that's been happening in the economy. And quite frankly, just the bond market and the banks are basically saying to the Bank of Canada, okay, guys, we're ready. The economy is saying we're ready. Start hiking those interest rate hikes. Now, there's been a lot of interesting conversations around this. I think I'll start first and foremost with one of the obvious ones, which is why are variables even more attractive? As of right now, you'll see when we get into the interest rate numbers, fixed rates are up around 3.79 to 4%, which means the new qualifying rate for fixed rate mortgages is about 5.79 or 6%, which is substantially higher than what you have to qualify for a variable rate, which is 5.25%. Because remember, that stress test is based on one of two things, either 5.25% or the contract rate, which is the rate you actually pay for the mortgage, plus 2%. So variable rates right now are still being qualified at 5.25%, and their fixed rate counterparts are being qualified at substantially higher rates. So what that means is if you're choosing a fixed rate mortgage right now, whether you like it or not, whether you feel like there's security in that or not, you're qualifying for less mortgage. Now, that should have a downward impact on the economy, or it should create a little bit of a headwind on real estate prices. But the reality of it is there's even more incentive to take a variable rate. I'm not sure that's a good thing, but when you look at the difference between variable rates and fixed rates right now, even with a 0.5% interest rate increase, it probably still makes some sense to take a variable rate. And we'll get to that a little bit later on. Now, the other things that are happening are a major run up in the bond market. This is happening as money is flocking out of the bond market. Therefore, bonds are getting cheaper. I want to start by showing you March 1st of 2022, the last time we did an interest rate update. This was the 5-year Canada bond yield. It was 1.48%, and it had come down off a high by about 25 basis points from, a week or two earlier. Now, if you look at the 5-year Canada government bond yield, it is up around 2.5%, which means we've effectively seen about 1% in upward pressure on 5-year fixed rates because 5-year fixed mortgages are priced off of the 5-year Canada bond yield. So this is getting really, really interesting from an interest rate perspective because the bond yields are basically saying, okay, we're expecting a huge increase in interest rates here in the coming months, and therefore 5-year fixed rates are moving accordingly. In fact, I've never seen so many emails in a single month from lenders saying interest rates are going up. We've been getting them almost daily. Now, the interesting thing is every time we see these 5-year fixed rates go up without the variable rate mortgages moving at the same pace, what it means is that the variable rate mortgages are getting more attractive. So even though you may think that it now makes sense to lock in because it looks like all interest rates are going to go up, the spreads between variable and fixed are getting significantly bigger. And therefore, for most people, when they look at the difference between the payment they're paying now and what they would pay if they were locking in, well, it makes sense for them to stick with their variable rate mortgage strategies, even with a 0.5% or a 1% increase on the horizon. Now, obviously, this comes down to a personal decision for most people, but let's take a look at what would happen if a 0.5% interest rate increase happened in the next week or so, which it likely will with variable rates. Well, for every $100,000 in mortgage, it means about a $9 increase per week in interest rate costs and about a $5 increase in payments. Now, combine that with the conversation around how much we expect interest rates to go up over the next year or two. Many of the big banks are saying that they are predicting about 1.75% in increases over and above the 0.25 that we've already had. But the question becomes what will happen when they start increasing by 0.5% and then another 0.5%. And we start to get to that point where interest rates have increased by 1%. If you go and you watch Steve Saretsky, he's got a really interesting video on this recently where he talks about his views. And obviously we have to be really careful when we're looking at predictions of people on YouTube or the bank economists or anybody else for that matter, because everyone's got a lens that we're framing this through. And somebody like Steve, somebody like myself, we're both in the same boat. We both believe that interest rates probably aren't going to go up as much as expected. And there may be a little bit of bias based on the fact that we're in the real estate industry. We may be predicting this completely wrong, or we may be right. But what's going to be interesting is what it looks like when interest rates have gone up by 1%, and if it looks like they can continue to go up from there. Because when they do go up by 1%, we are going to be facing a different set of information than we have right now. Inflation numbers will look different. Jobs numbers will look different. All the numbers will look completely different than they do now once we've increased interest rates by 0.5% and then 1%, and then for every subsequent increase after that. So it's going to get really interesting from a 3 to 6 months to a year down the road perspective. And nobody's able to accurately predict what's going to happen. I mean, nobody expected that Russia would invade Ukraine. Nobody expected that the upward inflationary pressure that has happened would happen. Some people will tell you that they expected that, but obviously that's because they were looking at things through a different lens and it just happened to come true. Anybody who was predicting that interest rates were going to go up substantially in September or July of last year and then is saying, hey, look at me, I predicted that. Well, they got some assistance from Russia and they got some assistance from the things that were happening in the world that nobody expected. Otherwise, they may have been right, but they may not have been right either. So, it's really interesting. And the only thing we can do is when we're looking at mortgage decisions and interest rate decisions is use the information that we have now in order to determine what's best for us. And the only way you can do that if you're getting a mortgage right now, or if you already have a mortgage and you're thinking about locking in, is by looking at the difference in the payments and the interest costs, and then looking at it from the perspective of, okay, if I lock in now, how many interest rate increases will it take before I am no longer saving money? And then how many interest rate increases will it take after that in order for me to start eating into the savings that I've already had from the time where I've had a lower interest rate? So right now, if you have a variable rate mortgage at 1.7% and you're looking at a fixed rate at 3.7%, well, you need 8 interest rate hikes before you are no longer saving money anymore. And then you're going to need a further 8 interest rate hikes or about that in order to cancel out all the time that you've had savings. So you basically need about 16 interest rate hikes or the equivalent of 16 quarter point hikes before you're substantially worse off. And then what happens if interest rates go up by 1%, it tanks the economy and then they come back down. Because here's the thing, I'm pretty sure, I'm reasonably certain that in the next 5 years, even when we see interest rates go up, we're going to have a couple periods where we start to see them come back down as well, because central banks have a tendency to overshoot. And at some point, we're going to see some sort of recessionary pressure that's going to require interest rates to come back down. Now, I could be wrong on that, but that's my guess and that's my prediction in the long run. I don't know how much they're going to go up, but I can almost guarantee you that in the next 5 years, we're going to see them come back in some way, shape, or form down to a level that is off the highs that we hit in the next 2 or 3 years. So without further ado, let's jump in and take a look at the actual interest rates and how much they've increased. First and foremost, this rate is as of tomorrow, not as of today, not as of the day of this publishing, because we already know that interest rates are going up by another 0.1% tomorrow. For a 5-year full featured mortgage that is insured or has greater than 35% down, these are the mortgages that represent very minimal risk to the lenders. You're looking at about 3.84%. From there, when you start getting into that range of between 20% down and 35% down, these are the more riskier mortgages for the lenders because they don't have insurance and because they are the lowest amount of down payment that the lenders have without insurance. You're looking at between 3.84 and 4.09. Obviously, if you're putting 20% down, you're at the 4.09 range. And as you get towards that 35% down payment amount, you're getting into that 3.84% range. Now, here's where it gets interesting. Look at the variable rates. The 5-year full featured variable is now priced at 1.6%. Last month, it was priced at about 1.35%. When you start getting into that 20 to 35% down payment range, you're looking at between 1.65% and 1.85%. And then moving into the discount mortgages, these are the mortgages that have certain restrictions or they have certain features stripped out. 5-year discounted rate is now 3.54%. This is the type of mortgage that comes with a bona fide sale clause or comes with significantly higher penalties, which means if interest rates do go down, which I suspect there's probably going to be an opportunity in the next year or two to get a lower interest rate than 3.54%. Could be wrong, but that is my guess. Well, if you are in the market for that and you've got a restricted mortgage, you may not be able to get a lower interest rate somewhere down the road. You give up features just like everything else in life when you pay a lower price. And the big thing we say about mortgages is the interest rate is an indication of the price, but it's not the actual price, because there's also sorts of other things like the features, the prepayment privileges, and the opportunities to save money down the road that all factor into how much you're going to pay for a mortgage in the long term. By the way, if you're in the market for a mortgage right now and you don't know what to do, you don't know what to do with respect to getting the lowest interest rate and getting the best deal, whether your bank is going to give you the best deal or a broker is going to give you the best deal, and what landmines and surprises we're talking about when we talk about discount versus non-discount or full featured mortgages, well, we've got a really great course put together for you called Secrets to Getting the Lowest Interest Rates. It is the single best resource for understanding how to negotiate a lower rate while not giving away the kitchen sink and doing all the things that are going to cost you money down the road. It is priced so cheaply because this is interest rate week. Every time we do one of these interest rate updates, we put it on sale. It is on sale right now for $47. All you have to do is go to ratesecrets.ca to sign up for that course. And I can pretty much guarantee you it's going to get 10 to 50 times your money back just by having the tools, the tricks, and the knowledge in order to get a better rate without basically getting screwed by your bank or your lender or your broker. So ratesecrets.ca if you want to jump in and grab that course. And obviously you've always got Mortgage 360 as an option to do all the work for you if you'd like to do that. Now, getting into that 20 to 35% down payment range, you're looking at between 3.54 and 3.79. And then if you're getting a discounted 5-year variable rate, you're looking at about 1.35%. Now, the big thing here, why I don't like this mortgage, is it comes with the restriction that you can't switch to a different lender. And therefore, what that means is that if you ever do decide to lock in, you pretty much have to lock in at whatever interest rate the lender dictates, which is why I tend to avoid this, because obviously flexibility in mortgages is everything. You will save more money by having flexibility than you will by saving 0.1 or 0.2%, because honestly, flexibility is that one thing that if you have it, it gives you more options. And when you have more options, you have more negotiating power. It means you can leave, you can switch, go to a different lender, or you can use it as leverage with your existing lender in order to get them to give you a better deal. By the way, 5-year fix at big banks are a big no-no in our mind because they have massive penalties, and those massive penalties end up putting you in a situation where you pretty much have no ability to leave if you have an interest rate differential at the time. And they have some tricks in there that are built in to make sure that you will have an interest rate differential more often than not. Now, getting into that 20 to 35% down payment on these 5-year variables, again, these are ones that I don't recommend very often, but you're looking at between 1.45% and 1.65% when you start stripping out some of the features of the mortgage that could save you money down the road. And if you're looking for a way to improve your situation, to get a better rate, one thing we do recommend right now is if you can get a better variable rate, that's quite often a better option than switching to a fixed rate. The reason why is because if we can get you a lower variable rate that's 0.25 or 0.5% lower than the one you have right now, well, we basically get to cancel out 1 or 2 interest rate hikes by switching you to a different lender. So if that's something that you want to take a look at, and if you have an interest rate that is less than prime minus 1, definitely go ahead. Go to our website, hit the apply now button, and we can definitely take a look at whether or not we can improve your mortgage situation by getting you a lower interest rate. Now, going back to that question of whether or not it makes sense for somebody to switch from a variable to a fixed rate now, well, the honest answer is no, it really doesn't, because the interest rates to switch into are so high. And most people who have chosen a variable rate, even with a 0.5% increase coming up and a 1/4 point increase that happened last month, are still probably doing better off than if they'd chosen a fixed in the first place. So one thing to keep in mind here is we've talked a lot about variable rate strategy on this channel in the past. And obviously the fixed rate mortgages aren't making a ton of sense right now, both from a qualifying perspective and from an interest rate perspective, and from a perspective of we don't know what will happen when interest rates are increased by 1% by the Bank of Canada here. That could lead to a recession, and it could lead to lower interest rates down the road. And we know that that is something that is very much possible. But at the end of the day, when you take a variable rate strategy, you have to keep in mind that this is a long-term strategy. We're looking at 25 years here, and we're looking at the long-term benefits of a variable rate. And over time, it is almost certain, regardless of if interest rates are going up or whether they're staying the same or whether they're going down, that if you take a variable rate strategy over the long term, you will almost always win over the long term. And you may think that you're going to do better with a fixed rate. And some people who were able to get fixed rate mortgages that we were able to put into fixed rate mortgages at 1.5% or 1.75%, yeah, they're going to do really, really, really well. But there was a small window of time where the variable rates and the fixed rates were so close together that it made sense to take a fixed rate mortgage. Obviously, those people who took the fixed rate mortgages understood that they had potential interest rate differential exposure, they had penalty exposure, but they'll probably do really, really well. But for the rest of us who took lower variable rate mortgages over fixed rate products, we're probably going to fare better over the long term, given that that was the circumstance that we had when we chose that mortgage. So for the most part right now, stand pat, stand your ground. If it really concerns you and you want to lock in, go ahead and lock in, but know that you've got about 8 interest rate increases before interest rates get to where the lock-in rate that you're going to lock in is at right now. Obviously, we'll keep you updated right here on this channel as the Bank of Canada rolls out its rate decision. And if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video. Don't forget about that race to 25,000 subscribers, and we'll see you on the very next one.